Welcome, everyone. On today's podcast, we have Harry Nelis, partner at Accel. He's been there for 17 years, has seen a lot of really great companies, and we're going to talk about them today. But first of all, welcome, Harry.
Thank you. Thank you for having me, Carlos.
I want to start off with your background. We always like to start off with a little bit about the person before they became successful or where they are today. I know that we were chatting a little bit about some of the things that you did and companies you started prior to being at Accel, but maybe just walk us through, what you studied undergrad and what was the first job you took?
All right, cool. So first of all, my accent is Dutch. So if you were wondering, born and raised in the Netherlands, ended up studying electrical engineering. In those days, computer science didn't exist yet. Ended up doing a Ph.D. in essentially applied math and signal processing, and ended up at Stanford in that context. So when I was done, got my first job at HP Labs on Pace Mill Road in Palo Alto, and was a scientist. So I sat in a cubicle working on graphics processors, the graphics processors that will go into workstations and that are pretty similar or have many things in common with the kind of processors that NVIDIA makes today. So I was a scientist for 3 years, was very interested in becoming more involved in engineering and engineering management. So transferred out to a workstation division of HP in Fort Collins, Colorado for a year. And then had an idea about a new product, a new business, and ended up leaving Hewlett Packard, got some seed money from friends, and became an entrepreneur, started a software company. Raised money from Greylock, who in those days, because we're talking 93 now, in those days were just setting up their office on the West Coast. But Greylock originally was a Boston-based firm, so raised money from Greylock and became a founder, CEO of a startup company. I was the CEO for a couple of years. Then became the VP of engineering after us having hired a quote unquote experienced manager and a CEO. We can dive into that later on, Carlos. So did that. That company merged with another private company. I left, didn't quite know what to do, went to business school, was at Harvard for a couple of years, and then came back to London. And in '99, was first at Goldman Sachs, where I joined the PIA, their principal investment area, essentially investing in kind of later stage private technology companies, and then joined Accel in '04, who had just set up an office a couple of years earlier in London. So that's my very short history pre-Accel.
Yeah, well, there's a lot to unpack there. So I want to go and jump back into, especially during the time when you were a founder and working on some of your company. Walk us through, I know you were sharing with me an anecdote about sort of your evolution as leadership in the company. Talk us a little bit more about kind of how the company grew, like what was the sort of the maximum employees that you had at what point, and then kind of how you evolved as a CEO during that time?
Yeah, so when I joined, when I started, I had recruited 2 co-founders, so it was the 3 of us who started the business. So in the very beginning, it was just 3 people working out of our bedrooms. I think it got up to 40, 50 employees in total before it merged with another private company. Really what I learned is how incredibly hard it is to start a business from scratch, and how incredibly hard it is to create a new product, to get customers on board and get the market timing right. I mean, essentially we were a few years early with our product. So I have ultimate respect for people who build businesses from scratch. That's one. And then 2, I think I have a lot of empathy for entrepreneurs who have to go through a quote unquote founder transition, whether it is parting with co-founders, whether it is giving over the reins to the company to a new person who will come in, put his stamp on the company, bring in his people, and how hard that is to kind of hand over your baby to a new person. So I think from those days, it's a long time ago right now, but they were pretty formative learnings. So I have a lot of empathy for for people who go through that.
Well, walk us through kind of the moment when, I mean, and perhaps if you want to like reference any of the companies that you've worked with or that there's a moment in some cases where you see there's a benefit to the founder or the founders of bringing somebody external to supplement them. In our portfolio, we have 1 or 2 companies where it was entirely so relieving to hear from the founders. And actually, I interviewed one of them on the podcast, the founder of Sabre, who shares his anecdote about bringing in somebody external to help guide the company and how much of a relief it was for him. And so I'm just trying to understand kind of what was that transition like, and also what was the role that you ultimately took once that was over?
Yeah. So with regards to Accel, the beginning of your question is, I think it's important to note that in many cases, the really successful companies are actually founder-led. So our strong bias at Accel is to try and keep the founder in the CEO seat for as long as possible, because those companies tend to be the most successful. Now, there is, in founders' minds, and I know that firsthand, there's 2 kind of thoughts. There's the rational thought and there's the emotional thought. Very often founders come to a point where rationally they know it kind of makes sense to ask for help and bring somebody else in. But emotionally, that is kind of a different matter. And of course, in your brain, the emotional and the rational kind of get mixed up. So very often people know, yeah, it's probably the right thing, but emotionally they also know, I'm not so sure if I want to hand over my baby. Can somebody really do it better than I can? And all that is kind of mixed up in one thing. And I think the task of a coach, which I really see myself as, is to help and unpack that with the founder, and then we'll see where we end up. I mean, you cannot force these kind of transitions. The only thing that you can do is help people on that journey. For me, in the days, it was, I was very young. I was 27, turning 28. I had only started to work when I was 25. I pretty much was new to America. So it made sense that I got relatively early on, after a couple of years, an experienced manager in. Now, there are, and of course, every experienced manager is not the same, but there is a reason why experienced managers are at larger companies for a long period of time, namely that they tend to like status quo. They tend to have built really large organizations that of course cannot pivot very nimbly. So there are real definite challenges with hiring quote unquote experienced managers as well. In my case, the first quote unquote experienced manager that we got on board did not stay longer than a couple of years or so.
Well, I want to jump deeper into some of those topics as we discover a little bit more about your journey within Accel. And so I want to jump straight to kind of when you joined, and it's 17 years is an amazing career, and you've seen probably just about every kind of scenario that an investor can see.
There's one thing that I've learned is that I find out a new way to lose money every year.
Every year.
You just keep learning. So
that's good. That means you're not playing it too safe. That's good.
No,
that's good. Well, I want to kind of go through some of the companies that you've invested in. I don't know if you want to name check any in particular, but maybe just kind of give us a sense of your journey in terms of investments that you've made during your time at Accel. Like which ones you like to highlight and maybe why.
Yeah. Okay. Great. So first of all, so when I started in the beginning of 2004, the European venture capital market was dramatically different from the way it is today, right? So in those days there was Accel, who had opened an office a couple of years earlier. There was Benchmark, it was still called, which is now what Bulletin is. And there was Atlas essentially in London, and they were kind of the pan-European venture capital firms, and that was pretty much it. And typically they ended up investing in the UK and Israel. And when I joined Accel, there were no investments that had been made in France or Germany or anywhere else. So it was still a pretty small business. The kind of companies that I've invested in that people might know is I was an early investor in KAYAK. That is, of course, a US company, but the background there was KAYAK had already General Catalyst on board in the US, and they wanted to expand into Europe very early, and they wanted to get a European venture capital firm on board. And what's better than to have a US firm with a European office? So I joined the KAYAK board back in 06, I believe, 05 or 06, 05, I believe actually, and traveled that whole journey with KAYAK until they went public on NASDAQ, and then were acquired by Priceline, which is what now Booking is, for 2.2 billion, I think in 12 or 13. So that was a really interesting journey, and it's also interesting to kind of compare and contrast it with Check24 in Germany. So Check24 is a household name in Germany. It's the KAYAK for personal financial products, from car insurance to home loans, to home improvement loans, to gas and electricity contracts, etc. It's a very big business in Germany. And I invested in the business around the same time, but we're still investors in Check24. So in KAYAK, we ended up selling the business in 2012, so 8 years ago. We're still invested in Check24. And what it has shown me is when businesses work, what a long runway they still have ahead of them. So I think one of the mistakes one can make is to sell businesses early. I mean, what I've learned is once businesses work, they can go for a long way, and they become really, really big. So yeah, so those are the businesses I've been involved in: KAYAK, Check24, Solonis, which is a software company in Germany. They focus on process mining. World Remit, which is a remittance company. Showroom Privé, which is an online fashion retailer in France, which went public in Paris. Funding Circle, which went public here in London. So I've done all kinds of stuff. So I've done travel, e-commerce, software, you name it, financial services.
I mean, that's covering quite a broad range of things, although there is a little bit of a pattern there. Definitely marketplaces and fintech. And what's interesting though is, you're obviously covering some things that are also consumer facing versus enterprise facing. And you mentioned about letting companies scale rather than selling too early. What was the first mistake you made that you look back on as an investor? Because I mean, we talked about mistakes, and you can learn every year new mistakes. But with such a broad range of companies that you've covered and seen, you look back in maybe your first year or 2 or 3 as an investor, and what was the biggest mistake? And it doesn't have to be specifically about a bad investment, but like a wrong mindset or wrong assumption that you made. Maybe you could do again.
So I don't want to mention the company specifically. I think one lesson that I learned is that you cannot really change the DNA of a company. So if companies have been around for a while and have gotten into certain habits, into certain mindsets, etc., then I think it is very hard to actually change that, to undo that. So that's one thing that I learned, which is really, really important. Another thing that I learned is that you can actually find out a lot in due diligence, and like proper referencing and doing your homework. And by skipping things and cutting some corners, you can miss out on pretty important information that ends up being quite critical later on. So that's it. So doing your homework, and of course that's a challenge now because in a market that is as vibrant as it is today, there's very little time for diligence.
Yeah, and actually, I was going to ask you a little bit about the evolution of the ecosystem, and I think that that's a point that I would actually maybe we can pause it for that point in time when we talk about it in a little bit. But yes, the speed at which things are happening does prevent certain things from being done in the way that maybe should be done. But we'll revisit that idea in a second. When you look back at a lot of the founders that you worked with and the CEOs you worked with, what are the habits that you've seen that they have that you admire the most?
I was thinking about that. It's an interesting combination of a number of things, right? It's a cocktail, and there's many different cocktails that work. So there's no particular cocktail that is the cocktail, but it typically is a combination of curiosity, and disregard for how things are normally done, into a sense of intellectual honesty, an enormous amount of perseverance, but then also a certain amount of flexibility, because especially in the beginning, you have to maneuver, go left, right, and you cannot be stuck on a particular path. And then there's a very important one, is a certain amount of salesmanship. And that salesmanship, not only towards investors to get money on board, but most importantly, salesmanship and towards new recruits, co-founders, early employees. An ability to sell the dream and to convince others of the dream so that they join you. Because at the end of the day, it is really the team that makes things happen. And it's the founder who puts the team together. So ultimately, what the great CEOs have in common is that they can sell the dream, they can portray the dream, and get other very smart people on board and pursue the mission that they have set out to pursue. Mm.
Now, with all that, I mean, this is one of those tricky questions that you can either dodge or you can answer. But basically, it's, with all that pattern matching in mind. If you met a company that was doing relatively well, but the CEO had none of those traits, to some extent less of those traits, do you think that you would invest in them on the basis that you might be able to coach them along the way for anything that they don't have? So, for example, the perfect example, this is culturally, some people are just not very good at salesmanship. They manage, the product sells itself, but that they could be further along if they had maybe a little bit more of this, a little bit more of that. How much do you see the investor as a coach in key attributes, or how much of it should just be entirely hands-off? You just find the right team and then that's hands-off.
It is a very tricky question. And in general, my view on my job is that I just want to be helpful. I don't have the thought that I can be really impactful on businesses. The only real impact that I could have is I could help mess it up. So I think a lot of investors and board members, not a lot. So I think investors and board members can be helpful. At the end of the day, it's the founder who needs to make it happen. In a way, we can get in the way of people in a negative way. And so the best thing to do is to not have a negative impact. So that's a very long-winded way of saying is you can advise and help, but I don't think I don't think it's helping that much. So at the end of the day, it's the founder entrepreneur who has to make things happen. And if he or she is lacking on some of those aspects, I would have to really scratch my head. It's always a balance sheet, right? An investing opportunity. So the opportunity would have to be really obvious, namely a massive market, massive tailwinds, maybe from offline to online transition, customers who are showing up themselves on the doorstep, etc., where you say, shit, I mean, this is going so well. We ought to be able to help engineer something, but it would have to be really attractive. So in the end, at the end of the day, we're in a people business, and it's all about people, and therefore the entrepreneur.
So talking about people, I mean, I think you've seen enough of the European ecosystem evolve, and you've been involved in the US one as well. What do we still need more of in the European ecosystem, people-wise or infrastructure-wise or financing-wise?
I think we're pretty close to where we can get. So what the US has and what we don't have is a massive home market that is relatively homogeneous, right? So the issue that Europe still has, especially when it comes to consumer brands, is you can build a brand in Germany, but if you then expand into France and the UK, you have to start all over again. So that's the bit where the US still has an advantage. But in other ways, availability of capital, I say check. Availability of great entrepreneurs, check. Availability of great centers for innovation, check.
Would you include the access to the same level of, if you look at the Valley, and that's a whole separate conversation post-COVID, because there's a diaspora of people leaving San Francisco and all this stuff. But would you say that the sort of the best know-how of like product management, VP engineering, a lot of that has been evenly distributed across Europe, or is that still sort of in progress?
Well, so I think in the very beginning, when I started and when you started, product management was kind of a role, especially product management in technology companies. It was a role that didn't quite exist in Europe, and all the great people were on the West Coast. I think what has happened is we're now company-wise in second or third generations of management teams who have been at successful start company number one, then went to company number two, company number three. So there is a base of very experienced product people here in Europe now too. That wasn't the case 5 years ago or 10 years ago, but I think it is the case now. So that clearly was an Achilles heel, because of course product management in an early stage startup company is very important. I don't see that as that much of a problem right now, because the real thing that has happened is the ecosystem of founders and experienced senior level people, VPs of engineering, VP of products, VP of sales, has matured, and there's enough people around who've done this several times around right now, and who are no longer learning on the job. So I think we're good here.
Well, that's good. I mean, that's very encouraging to hear, because you obviously have different people kind of saying different things, especially when they're going through inflection points in hiring, and they struggle to find it in the same way that maybe they do in the Valley, with different prices, of course. So as we fast forward on the company's development, I think financing tends to be a key theme that obviously affects companies at different stages in different ways. And I'm gonna go all the way to the very end, to the public listings or IPOs, direct listings, and all the things that are kind of trendy at the moment in terms of topics, because of how large the market is for some public markets. And if you look at KAYAK and sort of extrapolate a different outcome for it, if you go back in time and pretend that time of the listing was today, walk us through kind of how you would think about taking a company like KAYAK public, whether it be through SPACs or direct listings, or the way that you guys went about it.
Yeah, so there's kind of three options, right? One is the traditional IPO. Two is a direct listing, and three is a SPAC. I think the traditional IPO is in the US form, right? So you end up raising a relatively small amount of money, you end up with a float, like a publicly traded part of the shareholder register that's relatively small. You get a big pop if things go well. You get a big pop on an IPO, and then you actually end up telling. This is the interesting bit, and this relates to what I'm going to tell about SPACs and direct listings. You're going to be telling your story to the investment community, essentially through research analysts. So you end up not giving forward-looking predictions. Really what you end up doing is you end up speaking to the research analysts and banks who will write their research and who will kind of sketch how they feel that the company might do, in a direct listing and in a SPAC, you end up giving many more forward-looking statements about the company yourself. So you have a better opportunity to tell your story yourself, and not necessarily through research analysts. So taking one step back, in a direct listing, as it is practiced today, actually the company does not raise new money. So it's a direct listing essentially is an okay, the shares become listed, and the shares that end up trading are existing investors who decide to sell their shares, not the company, and external investors buy it. So the company doesn't raise money, which of course, if the company does need money, it is not that great a fit. In a SPAC, just for the people who aren't familiar with it, a SPAC is a company that only has a whole bunch of money, call it $400 million in cash. It's been raised by, that's it, no IP, no management team, no nothing. It's raised typically by a financial sponsor, but it's publicly listed. So the shares in the SPAC trade. And then the way for a technology company to raise money is to merge with that SPAC and get the cash and a public listing all in one shot. The advantage is, as I mentioned, that you can tell your story more yourself. The other bit is that a SPAC attracts a different kind of investor, because whereas in an IPO, people typically know that, okay, there's likely going to be a pop. So it attracts investors who might leave after the pop. Whereas in a SPAC, it's actually more accurately priced. So there's no big discounts. So the people who invest in who are in the SPAC better love the company. And the interesting bit, of course, is that the investors in the SPAC don't know what company the SPAC is going to buy. So there will be a turnover in the shareholder register of the SPAC itself once they know what the company is that is being bought. So there's many more options right now. And it really depends on what the company needs to achieve. If the company needs to raise a bunch of cash quickly, then maybe a direct listing isn't a great option, because in a direct listing, you don't raise money. You do an IPO and you do it in a SPAC.
But if you look back at the KAYAK example and kind of make pretend that situation were live today, right now, I mean, there's this universe of options that you could, as you mentioned, you went through, that you could have as a founder or as an investor group. And I'm just curious to see if your choices would have been any different today.
I think because we wanted to raise some money at the time, I think we would have chosen between an IPO or a direct listing. I don't think we would have chosen for a SPAC. The IPO served us perfectly all right. So some of the issues is, okay, if you need to raise a very big amount of money, right? The criticism of an IPO is if it pops by a big amount on day one, that essentially means that you have mispriced the offering, right? Because if you price it at 100 and it pops to 150, then the company has left money on the table. If you raise a relatively small amount, then one can say, okay, who cares? If you raise a big amount, obviously that's more relevant. So in the case of KAYAK, we ended up raising a relatively small amount. It was, I think the stock popped 20 or 30%, so which is not massive. So it was not massively mispriced.
Mm-hmm.
I think we probably would have chosen for the same thing.
Yeah, and if you look at one of the things that I told you I wanted to chat with you about is
Well,
how
one
much.
One of the big things, Carlos, by the way, for investors is when to go public, because of course going public is it's not the end of the story. It's just a different kind of financing, right?
Yeah, exactly.
But investors end up holding public company stock, which is freely tradable. So there ends up being some pressure from LPs who say, okay, well, the stock is public, why don't you distribute things? So, which means that the VC kind of ends up exiting earlier than he or she may have liked. So if a company goes public, the venture capitalists end up kind of leaving within 1 or 2 years. If it's a company that has a long and wide runway, maybe you don't want to do the IPO earlier and just postpone it, because then you just can keep motoring for a longer time, right?
And this is, you touched exactly on the topic that I wanted to add, and you beautifully brought it together. And we have like 3 different ideas that are kind of all pushing in different directions. You know, selling too early, holding on to the company is the most valuable. How do you provide liquidity for people that are in the company, at the same time having it be accessible in a public way for new investors? And all these things are all pushing against each other. And with one trend also in the background, which is companies are raising more and more capital, records amounts of capital at the private level than ever before in history. And their need for external financing is no longer even there. Like they have so much money in private markets that externally sourced capital isn't like the main driver, which then forces or makes it more attractive to do direct listings or SPACs. And I just wanted to get your sense of how you think that's going to evolve, because as more companies have all this growth capital from the sidelines coming in, that's, there's the pressure of the internal investors wanting liquidity via private secondary markets internally, but also wanting to have that be maybe a little bit more publicly accessible or maybe more available to people. How do you think that's all going to play out?
I think it all depends company by company, right? But for the really great businesses, I'm a big believer of staying private as long as you can. And by the way, the really great businesses don't have to raise a lot of external capital, because they end up becoming profitable, cash generative, and just can keep going for a long, long time. It is not easy to run these very still delicate businesses. So in the view of a venture capitalist, we might think of these businesses as big companies, right? If they have a few $100 million in revenues. Typically in the big picture, they're still tiny companies in massive markets. So, and all kinds of stuff can happen to these tiny companies, which really means that things are not always that predictable, right? So if for a small business, you have to predict things every quarter by quarter, that's not so easy. So my advice would be, okay, stay private for as long as you can, until you feel that the business has become really predictable. And of course, in SaaS businesses, which tend to have pretty predictable revenues, that's becoming easier. I think that the trend that we have right now, where there's more and more private money available, where companies keep raising money in the private markets, where they go public much later, will continue. It's a trend that makes total sense. It's a trend that I don't think will reverse, and there will appear solutions for issues such as, okay, some investors may need to have secondary money available because they need to exit earlier. It tends to be the earlier investors who really were involved early on with the business. They may not be institutional investors, they may be smaller funds. I think the more institutional, long-term oriented investors, would be smart to just stay with these companies for a long time.
I mean, it's interesting because it's spawned a whole industry of different weird little ways of solving that problem. And there's a whole cottage industry of that right now. And then on top of that, there's a whole emergence of private/public markets, like, I mean, a perfect example of this is like some of the crowdfunding platforms that have within them a secondary market so that people that are part of that crowdfunding, so we're seeing this evolution of this ecosystem to enable liquidity for early stage investors as the company grows and stays private, because as you said, like it's always preferential to stay as private as long as possible. But I'm curious to there's like, it's a clutch, like a SPAC feels like a little bit like a clutch mechanism in enabling like a transition from private to public. But if you look at how all these things are evolving, if you fast forward 5 years into the future, what kind of investor do you think is no longer going to exist? Like, because there's so much like big money coming in early and, so much available capital, like if you had to predict what kind of investor, and this is probably exaggerating it because they're always going to be around, but just like if you had to pick what kind of investor you think will not be around 5 years from now, what would you predict?
I think all of them will be around, but I think things are going to specialize a lot. So people are going to be forced to swim in their swim lanes. So there will always be, we just spoke about the trend, there will be always be later stage investors. There will always be venture investors, and seed investors, et cetera, et cetera. I do think that early on, for example, when we were with Accel in Europe, we ended up doing quite of a broad range of things in the same fund. So in the same fund, we ended up doing seed investments and we ended up doing later stage investments. I think the trend clearly has been that things will separate and there will be different funds for different purposes. I do think that that the later stage market will be hyper competitive, and part of the reason is that the most difficult judgments to make are the ones about people, entrepreneurs, product that haven't quite found product market fit, and you kind of have to do that in person locally. However, when the opportunity has become the opportunity to invest in a business where there is P&Ls that you can look at, where you can put a ruler against the trends and predict a few years forward, then that all becomes more, it becomes a little bit easier, and it becomes a little bit easier to do it from a distance, which necessarily means that there's many more people who can do it, and that becomes hyper competitive. So I think the earlier you go, the earlier or the more things are centered around people, about contacts, around networks, and the more local that will be. And local means that there's a certain amount of friction, because local means that people who are far away have a hard time competing. And I think that becomes a bit easier.
I think one of the knock-on effects of all that competitiveness at the late stage, and this is a knock-on effect, I think, is that there's round inflation. And round inflation can either come in terms of round size or the round valuation, which then has a trickle-down effect into, you look at sort of the last 5 years and you look at the average round valuation for companies in the same stage, it goes up and up and up. And there's two answers to that. And I'm not gonna let you get away with the easy one, which is like, well, it's price parity relative to the US, and it was underpriced or under premiumed because of the evolution of the founders in Europe versus, that's the easy answer. I'd like to see if you have a view on what that implication is of that sort of ongoing price inflation and that hyper competitiveness at the later stage. Do you think that there's a natural plateau for that? Do you think it'll continue to grow at the same rate in that round size, hyper competitiveness between late stage funds, which drives that valuation? Or do you think that there's a compression event that will come that will sort of, or it'll be super additional fragmentation of the Series A, pre-Series A, what's your view on the evolution of that?
Yeah, all right. So I'll give you a slightly longer answer because I think this is very important. So if you take a step back, what has happened is, in a way, we've had very high inflation in our asset class, technology companies. So what has happened, and COVID, as with many things, has accelerated. COVID accelerates trends. The trend that was happening anyway in our business was there's a lot of money available. For example, right now during COVID, the Fed has created, I think, 5 trillion in new money. All that money ends up in the credit markets. The money that traditionally was in the credit markets ends up in the equity markets. What are you going to invest in? Are you going to invest in a company that is shrinking because of COVID, or do you want to invest in a company that's growing, which then of course ends up being a technology company? So prices in the public markets have gone up dramatically, as you can see. Prices, therefore, in the private markets have gone up dramatically. And people have caught on to the fact that all the action in technology investing happens in the private markets. So you've got to be in the private markets. Lots of money around, big rounds being raised. Now, here is the mechanism, I think, that stops that. In building consumer companies, you can put a lot of money to work, because the key thing in consumer companies is customer acquisition. Customer acquisition costs money, and therefore, if you throw more money at it, you can acquire more customers more quickly, typically. Not all, I mean, of course, channels don't always scale, but you tend to be able to put a big amount of money at work. In enterprise companies, which is where most of the opportunities are today. Of course, there's this pendulum that swings back and forth, but right now it's in enterprise companies. In enterprise companies, there's only so much money that you can put to work effectively. And so you can put more money to work on R&D, you can put more money to work in hiring a sales force, but a sales force still consists of people. So there's only so many people whom you can hire quickly. There's only so many good people around at a particular point in time. So in other words, there's only so much money that you can put to work. I think people are learning that you can that there's an enterprise company has a certain pace at which it can grow. If you want it to grow faster, then you end up wasting money. So that's a long-winded way of saying is you can only put so much money effectively to work in enterprise companies. And I think that is going to provide that ceiling of, okay, will companies always be raising more and more money at higher and higher valuations? And my view is I doubt that. There are also already several companies with which I'm involved who get new term sheets for more and more money. And I say, you know what, you already have a lot of money on the balance sheet. Why take the dilution? We don't really need it.
Yeah.
I hope that answers your question.
It does. And I think that the interesting thing, and I agree, like, I think, and it's hard, it's a bit unfair asking you the question because it's a bit hard to sort of extrapolate what that sort of ceiling is of people being silly and offering founders just anything to get the deal done. And then of course there's going to be some founders that are going to agree with your view and sort of the view of like, actually, I don't need to take more, or this is silly dilution, or this is silly valuation. And there's going to be some that are like, no, I'll take the term sheet because it is. Well, Harry, I've taken up so much of your time. It's been absolute pleasure to chat with you.
Likewise.
And I feel like there's so much more that I could ask you that I have, like, would love to ask you, and maybe we'll do a part 2 sometime soon and just go into some of those nitty-gritty ones. But it was an absolute pleasure having you. On behalf of everybody who's listening, thank you for joining us. And until next time, guys, bye.
Bye.